Yes, I mean, the dollar is essentially the core question here. We do think, unfortunately, the dollar is facing both cyclical and structural headwinds. From a cyclical perspective, we can see that there are continuous flows driven by capital flows, that the repatriation of flows into the rest of the world, and also even from a valuation perspective, if you look at it from a near perspective, dollar is not cheap at all. From a structural perspective, we know that the continuous talk and recess about the dollar's safe haven status will continue to weigh on dollar.
All right, let's bring up, if we have that graphic, I want you to talk us through the shape of the U.S. yield curve right now and what that is telling you, because I know you have a preference for curve steepeners, yes?
Yes. Now, the interesting thing here is, if we look at what's happening in the U.S. from a fundamental perspective, and I know that we're going to talk about the Fed, what Fed is going to do. I think we agree with the consensus that the Fed is going to hold at this moment. Now, if you look at the economic data, the growth numbers certainly do not beg for a cut. Unemployment actually has been pretty stable at 4.2% over the past 11 months. And you can argue that the retail numbers and other economic data are neutral to slightly soft on the side. So there's only one thing that if we want to argue for a cut, that will be the May CPI number. Under a normal circumstance, you can assign a higher probability that Fed could cut or at least signal a cut. But obviously, we all know that today we're not under a normal circumstance. There are still a lot of uncertainties in the world, not only on tariffs or on how tariffs impact U.S. economy, how tariffs impact from both the supply side and demand side of the U.S. economy, how tariffs impact inflation, and also what's going to happen on the conflict on the oil prices. So there are still a lot of balls in the air. As a result, I think the Fed is more than happy just to wait and see. And putting that all together, that comes, no matter what happens, you can still see there are more scenarios that pointing out to a curve steepener than anything else.
All right, so it sounds like you're saying basically that this is going to be led by the long end, and you favor duration?
Now, again, if you look at the overall economy, this is a very, very interesting point of time. Now, in the past, when we do forecast, we know that we can put a higher probability on the short-term forecast. Okay, 1 month, 2 months, economic data, growth numbers, inflation number. Now, because there are so many balls in the air, I think that visibility has come down. However, interestingly, I do think the visibility from a 9 to 12 months economic data can be relatively better forecasted. We do have a relatively higher conviction that from 9 to 12 months' time, we're going to see both weakening growth and sticky inflation. As a result, we favor the shorter end, and we do not like the longer end. Again, we have a long duration bias to reflect our weaker forecast on the economy, and with a steepener on to reflect our forecast of stickier inflation in the U.S.